When you look at the equity markets, which really have held up quite remarkably over the last recent weeks, is it because of the fundamentals such as earnings, or is it really interest rates because they've been so low?
I think it's everyone getting ready to resume and get back to normal. So I think the equity markets in particular are very forward looking and they're seeing the clouds lifting and back to normal and are really projecting growth. I don't think it's necessarily a result of interest rates. I think the rates market is actually the one that is catching up to equities because the 10-year, if it was a more normal environment, it would be pricing in an even steeper yield curve, which is actually healthy for Main Street. The whole banking system is premised on borrowing short term, lending long term, and the way for the Fed and the central banks around the world to really stimulate lending is to get a healthy upward sloping yield curve. Back in 2013, the yield curve was 250 basis points, and that was just normal. So we're really excited about seeing more normalization in the bond market, and I think it's a healthy sign for Main Street as well as the financial markets.
So, Ken, as an economist, is that the way you see it? Is basically, does the economic data indicate that the 10-year is actually lagging and is just catching up with the equity markets and what the economic data show?
Well, I completely agree with Nancy. The equity markets are very forward-looking, and they sort of see the vaccines coming, and they see this being over and are looking at that. I do think the interest rates are part of the story too. I mean, when interest rates are nearly zero and they're still projected to be very low for a long time, it makes equities, it makes anything look pretty good. It's bid up all asset prices much more than before. So, yeah, I mean, it's a variety of things, and of course, there's this gap between Main Street and Wall Street, in that the stock market does not include small and medium-sized businesses so much. It's not including a lot of the service sector that's really the hardest hit, the low income. So I think that gap's going to continue. And of course, the Federal Reserve and the government are sort of trying to stimulate everyone, but Amazon doesn't need stimulus right now. They don't need a 0% interest rate. It's really a different part of the economy, but the government doesn't really have a way of getting in a targeted way at the people who need the most. And so we have pretty hefty stimulus in the pipeline.
Well, Ken, just to pick up on that, as you well know, Larry Summers, your colleague, is warning that this $1.9 trillion may be a little too much, maybe a little too rich. Should we be at all worried about inflation, given where the output gap is and how big this stimulus looks like it's going to be?
Well, I think it's always worth listening to Larry. And I agree that there are definitely some short-term inflation pressures, but the question is it going to really change the underlying dynamic? I'm concerned about inflation over the much longer term for lots of reasons, demographics, globalization, but short term, I think there'll be some upward push on inflation, but I'm not sure we'll really see a loss of the anchor of expectations. That's really what the Fed's going to look at. And if that's not happening, they're just going to look past it and not raise interest rates. And I suspect that's what will happen for quite a while.
So, Nancy, you spent a lot of time on fixed income and looking at yields and things. Are you at all concerned about inflation? Or maybe I should ask, are we talking about reflation or inflation? There's a difference.
Well, I have a pretty different way of looking at inflation. I know most economists and investors, they look at various indices that are created, like, for instance, the CPI index is created by the Bureau of Labor Statistics. But I think that's like saying I own the equity markets and I have the Dow Jones, therefore I own equities. I think there are other ways that you can look at inflation and inflation expectations. And I think the yield curve is a more market-based measure, in my opinion, of that inflation and inflation expectations, that term premia. Like, if you think about it, the Fed has convinced the market that interest rates are going to be on hold for a while. The 2-year interest rate is currently 10 basis points. If you go out to a bank and you opened a 10-year CD, currently today you would only be paid 1.22% more, and that's that spread that you're showing on the screen, to lock up your capital for 10 years. So to me, the yield curve is a more market-based measure of inflation expectations, and it's trading well below normal levels. Even back in 2013, when policy rates were near the zero bound and we were coming out of the European debt crisis, it was just normal to have it be, 2.5% return on capital, assuming that you believe inflation will be coming. So I do think the yield curve is a broader measure of inflation expectations, and it takes it away from that CPI basket, which to me, the biggest downside of that is a huge component is shelter. And shelter, if you dig into the Bureau of Labor Statistics calculation, it's mostly owner occupied rent, and a lot of it is urban rent. So I don't think it's the best or only measure.
So Ken, are you concerned at all about the Fed's messaging on this? Because they certainly have been saying again and again, and we're not even going to think about the possibility of raising interest rates. If, in fact, they have to do that, as perhaps the vaccine kicks in, people come back, they have all that savings they pump into the economy, they have to make a move. Are the markets prepared for that possibility?
The markets are not prepared for that possibility if it happened. And certainly the Fed starting its hiking cycle anytime, and certainly sooner than the market was expecting, would be, a cold bath, a cold shower in the market. But that said, I think the Fed, on every, message it can have, it said, if inflation goes up, we're not worried about it. We'll let it be high for a while. Inflation is very slow moving. And again, I'm very worried about the longer term. I'm very worried that the stimulus is followed, which I wholeheartedly support, by the way, is followed by another and another and another. The economy normalizes and they don't stop, and people start to lose confidence. But it drifts very slowly. I think we don't know a lot about inflation expectations, but what we know is they move very slowly, at least in economies like the US.